Traders say they believe investors will continue to price Nigeria's domestic bonds higher as yields improved and with demand anticipated in the secondary market. As we wrap up the trading week, Bankole Odusanya, the head of fixed income trading at UBA, joins me now as we look into the markets today. Thank you so much for your time, Bankole. Interesting week in the month gone through in the month of May, but we've seen that persistent illiquidity and high OBBV rates continue. What for you? What's driving this, and how are investors reacting?
Thank you very much. The illiquidity is monetary policy induced as the central bank continues to use the CRR to mop up system liquidity rather than the OMO securities which they had used for years. What we have seen since last year is that OMO treasury bills that used to be issued on a weekly basis of volume of up to 400, 500, 300 billion had been reduced drastically to about 20 billion. So right now, they rely more on the CRR instrument, cash reserve instrument, to mop up liquidity. And the reason for doing this is to reduce the amount of naira in circulation that probably will push up the demand type of inflation or pursue dollars, USD. So basically, that's why they've used more of CRR and then reduced OMO bills issuance to mop up liquidity because of the cost of issuing this debt itself. Never forget that the amount of yield paid on OMO bills is a cost to the central bank.
All right, but looking at, let's move on to the bonds, and let's get your thoughts on what we see that play out there. Where do you see the FGN bonds yields heading, given this low yield of the liquidity we're seeing in the market and this bearish trend that we're seeing play out as well?
Okay, since February on the bonds end, we've seen yields continue to go up, but in this month of May, we are seeing some kind of peak, some kind of resistance, because for the long end of the bonds in particular, they are all at 13.7, 13.8, 13.9 levels. It's flat from 2027 bonds all the way to 2050 bonds. Is kind of flat at upper end of the 13%. Whenever any bank or counterparty on the Bloomberg shows 14%, it seems to be good enough for investors. So they've been picking 14%. It seems to be good enough. So it's a good, it's a major highlight to watch out for in the next auction, which will hold on the 19th. But basically right now, most of the demand action we are seeing in the fixed income market is on the NTB side, which had been very quiet because the yields were very, very low compared to OMO bills, which are 10%, and then bonds, which were at double digits, ranging from 12 to 14, like I explained earlier. So what we're seeing now is the NTB stopped last week at 9.75 with a potential to get into the double digit next week. So we have seen demand coming for NTBs. Of course, that's where PFAs and other asset managers can play because they are restricted from coming to the OMO end. So right now we're seeing demand creeping. I want to believe people are offsetting some of their equities and coming back to the Nigerian treasury bills because the yields are getting good enough. The discount is at 9.75, but however, the effective yield is already into upper 10% levels. So going into next week, it's a major space to also watch where rates will stop at the Nigerian treasury bills auction. One factor driving that already also is that the Debt Management Office has been in the last 4 to 5 weeks selling more than what they offered. They are offering 90 billion next week, but they could sell up to 120, 160 billion. Of course, that shows that they need to borrow more in funding this year's budget deficit. And as expected, most of the investors are asking for higher yield. There's high yield expectation with inflation and other factors to put into the bucket of considerations.
Interesting that you break down the treasury bills in that way, because I'd like to understand how much higher you think they will go and the implications you think it could have on corporate borrowing rates going forward.
Yes, we're looking at 10% on the minimum because it had moved from 7 to 8, 9, and 9.75, just stopping short of 10. But definitely we're expecting that by next week, with the volume they would like to mop or take out of to borrow, that's the Debt Management Office, we're expecting that it will get to 10 at the minimum, or could it will go as high as 10.5. That's for treasury bills. But what it simply means is that for fund holders, liquid units and the surplus units in the market right now, it's their market. They are calling rates as high as 9% for term deposits. And then we are seeing borrowers also offer 10% already. So markets have left the 2-3% where we started from in January, and we're back at double digits, really. We're really back at double digits.
All right, but let's get your implications for what we're seeing play out in the macro space with the MPC. I understand that later this month we're going to have that MPC meeting, and in before that time we're going to have the new inflation figures come out for the month of April, and as well as the Q1 GDP figures as well should be released around that time. How do you think this is going to impact the proceedings at the MPC?
Okay, I'll start from the inflation. Inflation comes out next week. We expect inflation to move from about 18.3 where it is right now to about 18.5 or upper end of 18 going to almost touching 19, because the factors remains the same. Food, which is the core element of that basket, remains a problem. The cost of food, insecurity affecting planting of food, and then distribution of food nationwide is a problem itself. And they are still having issues with sorting effects to import food, and then maize not being allowed to be imported, with rice being clamped down and all that. So all that is going to dovetail into the price of food and how it affects inflation. The factors remain the same. Inflation will continue to inch up. As for Monetary Policy Committee, we're expecting that the committee will hold still on all its stance and not necessarily change anything. We've had people speak on increase in rates, to use monetary policy rates in managing inflation. We don't think that will happen, because the central bank governor had said severally that it's not a demand type of inflation, but the cost push type. And then they would rather continue to manage cost of production and just cost of value being created in the system generally. So we expect them to use more of CRR rather than OMO bills or changing their monetary policy stance around their monetary policy rates.